Greetings, and welcome back to a special Halloween edition of the Rose Bros podcast. This episode, we are joined by Mr. Trent Boehm, known as the White Walker, on Twitter/X, for a zombie-inspired discussion on the energy markets. Most recently, Mr. Boehm held the position of Vice Chairman and Head of Energy Sales on the Executive Committee at Stifel Nicolaus Canada, which operates under the brands Stifel FirstEnergy and Stifel GMP in Canada. From 2016 to 2019, Mr. Boehm served as Managing Director and Head of Energy Sales on the Executive Committee at GMP Capital. From 2002 until 2016, Mr. Boehm was a Managing Director and Head of Capital Markets at FirstEnergy Capital, where he was a key member of the leadership team. Mr. Boehm holds a Chartered Financial Analyst designation, in addition to a Bachelor of Commerce degree from the University of Calgary, and is also a board member of Western Energy Services Corp. Among other things, we sat down and discussed recent energy market volatility, 2024 pricing, and why M&A is good for Canadian energy markets. Happy Halloween, everyone, and stay safe out there. This podcast episode is sponsored by Conate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Conate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@conatewater.com or check out conatewater.com for more details. This episode is brought to you by Canada Action, whose aim is to promote the importance of Canada's energy industry, which is the bedrock of our nation's economy, providing hundreds of thousands of jobs and economic opportunities across the country. Learn more at canadaaction.ca or check out Canada Action on social media. This podcast is sponsored by headracingcanada.com. In partnership with four-time Olympian Manny Osborne Parody, headracingcanada.com is offering European factory performance ski gear from its online storefront by passing brick-and-mortar savings on to customers. Check out headracingcanada.com for more info on the 2024 collection and get your high-performance ski gear for the upcoming season. Morning, Trent Boehm.
Good morning, Trevor Rose.
Thank you very much for doing this again. I really appreciate your time.
Well, thank you for having me back. I actually can't believe that you decided to have me back. When I look across the roster of speakers that you've had over the last little while, I can't believe that I'm in the same genre as real leaders in this industry like Ian Dundas and John Hooks and Mike Timms and so on. So thanks again, and it's great. Hopefully I can be of a little value.
For today, I thought we might structure the conversation around kind of an update on the market since the last time we spoke. So in honor of Halloween, we'll kind of structure this on a Halloween special and and go from there. So I also have to ask, why the zombie pseudonym for anyone that is
Why the zombie?
Yeah.
Well, I got the idea for the zombie from another pseudonymous Twitter user that I think that you did a pod with called Doomberg. And I just liked the idea of having some type of a brand that sort of reflected my personality. And in the case of the White Walker, first of all, I'm from the north, the far north, come from Slave Lake. Secondly, I'm in the oil patch, which means by definition, nobody likes me. And third, we never go away. We're always there in the oil patch. Mm-hmm. We always come back. And old White Walker, you know, the White Walker on the shows of Game of Thrones, well, he raised quite an army. So if I can build a Twitter army of zombies who care about oil and gas and that can portray the attributes of oil and gas in a realistic fashion in the context of everything that's going on in the world, including from everything from energy poverty to the environmental impact of energy resources of all different types, then I'll have accomplished my objective with my Twitter handle.
It's working too. Actually, I forgot to mention our first episode was a fan favorite. So
no way.
It's been popular. Yeah.
Well, thanks very much.
It's true. So it's working. But to get into it a little bit today, fall of 2023, maybe for the fans, anyone that is listening, we can get a bit of an update on things as we head into the winter and whatnot. Today was Chevron Hess, but for the listener, maybe Why is the M&A happening now, and what are your thoughts on it? Is it good or bad?
Well, there's been a parade of M&A transactions in the last little while. Chevron and Hess is today's topic. 2 weeks ago it was Exxon and Pioneer. In Canada, we just had Tourmaline and Bonavista. Mm-hmm. And yeah, there is a reason why these transactions are happening. And to cut to the chase, it is a positive. You know, the way I look at the market right now and the way investors are interacting with markets is there's a contest between issuers and investors. And that contest is centered around how do you generate market impact for investors as an issuer while pursuing your longer term objectives. Mm-hmm. And those aren't always the same things for an oil company. So the way I look at market impact is I analyze the standard deviation of the daily returns of an oil company in dollars. Mm-hmm. So for instance, in 2019, the top 5 oil companies in Canada would have a daily standard deviation of dollar returns of about $2.3 billion. So what that means is that if you added up all of those, the daily returns on an average day, that would have changed either up or down $2.3 billion. Today, that number's $4.3 billion. Well, the single stock ExxonMobil is $7 billion. So if you think about market impact and you're an investor and you're trying to get your energy bang for the buck, it makes sense to try to get exposure to those companies that have the biggest market impact. Mm-hmm. Now, back in 2019, it wasn't a very active M&A market. Mm-hmm. You know, there were a few deals, but not very many, and certainly not really high-profile deals down in the States. And from a Canadian perspective, it was really interesting. I just have some numbers written down here. But the top 5 companies had a market impact, starting with Suncor as high as $830 million, and ending with Ovintiv at $225 million. Mm-hmm. The other interesting thing about these values is that this number 2 in 2019 was Canadian Natural, and it was only $50 million less than Suncor. Mm-hmm. Okay, so let's fast forward another 4 years. The top 5, $4.3 billion, but $1.5 billion a day is Canadian Natural Resources. Mm-hmm. And then the next guy is Suncor. So Suncor has really done nothing in 4 years at $880 million. The next guy is Cenovus at $800 million, followed by Imperial at $726 million. And then Tourmaline crept into the top 5, which there's strong implications there for what I guess what I'm about to say. So what's happening is that our issuers in the energy sector spent a long, long time, Trevor, in a defensive crouch. Probably from, at the end of the day, really, it started in 2016, but it got really bad after COVID. And there were a few companies, for instance, like Tourmaline, that planted a flag and said, we're going to use this as a multi-generational opportunity to aggregate oil assets. That was a very, very short list of companies. It's starting to change. So what's happening is you have many companies looking at transactions, and it's in part because they see this significant change in market impact between large companies and smaller entities. And so they're now able to, because this has arisen, and it's arisen in part due to the fact that the environmental movement has now starting. The requirements to put up financial results have undermined the narrative of unstoppable growth in renewable energy technologies. Mm-hmm. And the market is now starting to realize there's going to have to be a compromise. And so now that that's happening, people like Darren Woods, Michael Worth are saying, we're going to get back to planning for 10 years out. We're not going to huddle in our offices and our boardrooms and fret about what large, ideologically, environmentally focused investors have to say about us. We're going to run our business. Okay, so how do we run our business? Well, what we do know is that if we want to improve our market impact and run our business, we have a real opportunity right now, because I can identify a company like, for instance, Hess, which has a significant growth play in Guyana, which will grow production for many years to come. And it is an anchor tenant in the Bakken, which will be it's no longer a real growth play, but it's a great free cash flow generating play. So it now sees a dramatic opportunity here, because it's already got Chevron already has large market impact, but by adding this organic growth company, it could continue that company's business plan, grow it, and get sort of a leverage on its own market impact, which makes it more valuable to investors. And that's part of what we're starting to see in the market. The other attribute that I think is really interesting right now is that small companies, the people or the issuers that aren't in the top 10, so below the top 5, they jockey around, and there's a massive difference. Like, I didn't even write down the values. But in 2019, number 10 was in Canada, it was $40 million of impact. Mm-hmm. Remember, that's before COVID. I mean, it wasn't a bad market back then. So $40 million of impact for a non-large cap seems pretty sad. Well, those numbers are now $200-300 million. The best large cap in Canada doubled its market impact. That was Canadian Natural. The other guys just sort of jockeyed around in that, between $500 million and $1 billion of market impact. But companies like Tourmaline and Crescent Point, Whitecap, and MEG, MEG is a really interesting one. They doubled, tripled, quintupled their market impact. So when you're sitting in the hallowed towers of the large caps, you're looking down below you and you're seeing who's really being effective here. Okay, well, we're running our business in this big company, but these guys down below us are really effective. It might be because of assets, it might be because of people, or some combination thereof. So the urge to merge, particularly given that valuation discrepancies are there, is almost irresistible at this point. And I think that you're going to continue to see two things happen. You'll see the mergers continue, number one, but number two, you'll see these issuers that make these acquisitions over time be rewarded because they're buying superior companies and improving their market impact.
Some people call it roll-up strategy. Yeah. Is that a good strategy?
It's time tested. It can be good or bad. It depends on financial metrics and asset quality and, a variety of other factors. History is replete with good acquisitions and bad acquisitions. My personal perspective is that acquisitions at this junction in history are a good idea. And the reason is this. We've gone through half a decade almost of limited investment in this sector. At first, it was limited because there was no cash flow in the sector and there were incredibly high levels of indebtedness. Yeah. Now, and it's kind of a shock, to be quite honest, but it's very impressive. Now, the discipline is just, a result of choice, a result of issuers following through on their promises. They are not increasing capital spending. Here's a bit of an anecdote, and you can talk to some of the other speakers that you have from the oil field sector about this. But what we're seeing in Canada in Q4 is a stark change in behavior amongst the issuers towards the oil field. Back in the olden days, if a company was maybe a little bit behind on its CapEx or just excited about its projects, they would have spent all their money in the first 3 quarters of the year and they would say, okay, well, clap their hands. Let's go. Let's keep this rig running. In fact, you know what? Let's get another rig. This Q4, we're seeing our customers say, we're through our budget, fellas. We'll see you on January 1st. Actually, make it January 2nd. We want to give the guys an extra day off. Yeah. So that capital discipline is a real thing. And there's a lot of noise in the market. Some companies will be penalized for it. Some companies will be rewarded for it. And you can't just look at any given time at one single metric. But on balance, what I'm seeing is a tremendous amount of discipline. So that discipline has resulted in lower base declines on average for this sector. Now, if you're an acquisition-oriented company and you make an acquisition of another company or asset that hasn't received any investment for 2, 3, 4 years, or just a slower pace of investment, you're going to be rewarded with a lower decline base. Great example of that is a Peyto Repsol deal from a few weeks back. That was the best deal Peyto could ever have done. It basically fit like a glove. It improved an already reasonably good decline profile, and its assets were literally what Peyto had been working on for decades. And they're under drilled. It's perfect. Peyto's plate is now set for another 20 years, and the big difference will be they will be able to generate growing dividends and free cash as a result of this transaction for the foreseeable future. It's tremendous.
Critic from Bay Street would say that's great and all, but I don't know where prices will be at in 5-10 years, and that I don't know whether you can structure this deal correctly. There's a lot of hesitation from the investors out there, whether they're tourists or... So you understand it all. You're an expert, but does it matter at the end of the day? The results will speak for themselves. The good acquisitions will pay themselves out. How do you convince Bay Street?
Well, it has become a religion in Calgary and in other places to pursue low-cost strategies and pursue maximal efficiency in your operations in order to maintain low costs, because it really doesn't matter where you are nowadays. The oilfield service contractors and the engineers at the issuers have gotten so good at bringing on volumes that it doesn't matter where you are. You're going to drill too much oil or gas for the basin you're in. That is just a fact. So what can you do about it? Well, back in the olden days, we just keep on drilling and hopefully we can sell this thing before someone catches on to the fact that, our margins are going to go to hell. But nowadays, companies are more measured, and they're taking a much more active role in their marketing programs. They are not implementing significant growth projects unless they have exit or, transportation. So, these are the characteristics of better businesses, is what I'm trying to say. Back in the olden days, you might even say that these were half businesses. They weren't even whole businesses. People were building resource and hoping to sell it to somebody who did have the marketing organized. Well, now even the smallest company will work actively and avidly to ensure that they have long-term egress to the extent possible. And I think it makes these businesses so much more compelling as an investment attribute to your typical buy-sider. I mean, if they were to be agnostic about what we produce, we could be producing widgets. They would say, oh, okay. Yeah, I can accept that the prices go up and down, but look at this. The costs are as low as they've ever been. Management appears through their behavior to be very disciplined, and the returns are great. Oh, and by the way, the multiples are between 3 and 5 years of cash flow. I mean, how can I not buy this? So these are the attributes that I think make this sector very compelling right now. And it doesn't mean there's going to be a groundswell of interest, because at the end of the day, it's a commodity-based business. But from the perspective of investors that are looking to identify sectors of the market that, barring radical changes in commodity prices, this looks like pretty good value to me.
The comments from the top, even Mr. Craig Brixa from Crescent Pointer, that it's going to take a few quarters or maybe a year or two to get the trust back. How long do you think it'll take to get trust back?
Well, you know what? I'll say that I'll say it's happening now. I mean, we have a situation, I think, in markets where generalist investors that are not machines are allocating more capital to this sector because the valuations are attractive and the sequential, the returns are good. And furthermore, but I think trust is one that nobody trusts anybody in this. You can't base a investment thesis on trust per se. I mean, it's how are my relative returns? And what's important to note is that the relative returns of tried and true sectors have been difficult. They've been difficult. Yeah, the S&P 500 returns are are predicated basically 100% on the Magnificent Seven stocks. I mean, you go outside that realm and it becomes a lot more difficult, and it becomes more of a stock picker's market. And so to the extent that an individual investor is a stock picker per se, well, we will be gravitating towards issuers in energy more than they had been in the past. In the past, these stocks traded at 6, 7, 8 times EV to EBITDA, and balance sheets weren't that great. And when we just spoke about how the businesses were run back in the early 2000s, so those weren't attractive to the so-called generalist who's agnostic to what the production are. So, but now you've got a situation where that is reversed. That's why I think that's happening even as we speak.
I guess another worry is that you can manage your business all you want, but as a commodity style business, price takers, it just takes one action from OPEC to totally erase your margins with a price crash. But on the flip side, you can argue the balance sheets are strong now, and that the businesses have changed and not as susceptible to the black swan. That may be one point to make.
It's absolutely correct. We've seen a radical transformation in the approach to the use of leverage, and it's been brought about by the discipline that has been enforced by equity investors. Equity investors were repulsed by energy for a lengthy period of time, and the people that did remain in the trade saw an opportunity to change behaviors, and they implemented those changes by encouraging companies to change their compensation practices, and it worked. So we have companies now being rewarded on financial metrics that have been more consistent with stronger returns on capital employed.
You don't have a crystal ball, but what are your thoughts on pricing heading into the winter? Are we stable? Is OPEC a worry? What are you thinking?
Well, I'm the worst predictor of price in the world, just so you know. But what I can tell you is this. All commodities, with the exception of metallurgical coal and uranium, are in a chop zone right now. And that might sound weird, seeing that oil's gone from 70-something to 89. But when you account for the volatility of these commodities, it's entirely predictable that I could go from 70 to $89. And so this is probably the most dangerous time for commodity trading advisors and trend following investors, because you can vaporize an entire year's P&L just watching oil go up $3 and down $3. As a result, that liquidity is out of the market, and it leaves investors in the market, longer term investors and commercial interests. So for oil, we're seeing a tremendous increase in volatility because trend oriented investors are saying, or tapping out, I'm out, right? And that's leaving, hedgers and people that just want to be long or short the stuff for fundamental reasons. And that's a smaller and smaller pool of investors every single day. So I predict more volatility until cross currents are enormous right now. Economic cross currents are probably primarily negative. Geopolitical cross currents are probably positive. So at the end of the day, we are going to suffer from tremendous volatility over the course of the next year, and I have no idea which way. Mm-hmm. You have to just be really careful. If you are Canadian Natural Resources or ExxonMobil, you just run your business. Oil goes up and down. Run your business. Try to be opportunistic when it tanks, and try to be disciplined when it rallies to unsustainable levels.
Mm-hmm. Some investors have been frustrated the energy equities haven't rallied like they thought they would be. And from your perspective, what does it take for the re-rating to occur? Why hasn't it happened yet?
So I was always the scourge of the re-rater analyst. Over the years, from time to time, an analyst would perk up in the morning meeting and say XYZ is ready for a re-rate, and I would always cut loose on these guys because the myth of the re-rate. I'd like you to go out in the window that we're looking here. There's a grassy field. I want you to go out and pick an individual, the best piece of grass in this lawn. Like, forget it. There's no possible way you could ever identify a company that's due for a re-rate. What you want to know is this company running a solid business with high returns on capital employed? And is it a good value? If it gets re-rated, great. But, your base case should always be, is it generating solid returns on capital employed? And what are they doing to reinvest that capital employed or return it if they don't have good projects? That's the way I've always approached it. I never bet on a re-rate when I look at a company. In fact, I always assume the worst. I always assume this is it. And that maybe I'm a little too bearish, but I always assume that it's never going to get better. It's probably going to get worse. And another weird characteristic of any commodity business is that without fail, the best time to buy them is when their multiples are the highest. And that's usually at points in time when the commodities have been completely destroyed and these things are trading at, when you look at them and it looks like they're going bankrupt, that's when you buy them.
Yeah, for sure. I remember you said that about Mr. George R. Moran was at his happiest when you were maybe at your worst.
Yeah, absolutely. One of the most courageous investors I've ever met. And and it's true. Buying ARC in 2020 or Crescent Point in 2020 was probably a pretty good idea. You only would have had a 10 bagger,
yeah.
Right? So I'm not a big re-rater.
Right. The worry back then was that even within the energy industry, people were unsure about the prospects. Well, not everybody. A lot of people knew that oil was going to be around for a while, but at the same time, people were worried that the prospects for the industry weren't that good. However, it seems like the page is flipped where maybe there's a broader realization that it's going to be around for a while. Like you said, I think that's factoring into M&A strategies, but have you seen that? Even within the energy industry, people are starting to maybe believe more in their own businesses and that I don't know, has there been a change in perspective or?
I would say to you that everybody in this sector now has a bit of a
confidence,
a bit more confidence than they would have had the last time we spoke. And, it's more measured. Yeah. But the idea that we aren't being murdered every single day by the vicissitudes of markets and politics as we were 2 or 3 years ago. And so as a result, we're structuring our businesses in ways that allow them to be robust and anti-fragile through a variety of commodity and regulatory scenarios.
Which has been a bit of a change.
It's a tremendous change. It doesn't mean there's going to be radical expansion, but it does mean that this industry is growing at a measured pace that's probably warranted for the quantum of demand. The one attribute of Canada specifically that I think is worth noting, though, is, in my opinion, it's almost impossible for Canada to not have a faster growing energy sector than other parts of the world on average, because the TMX pipeline, the debacle that it is, will be commissioned, and LNG Canada will be commissioned. That will be a significant increase in export capacity. But more importantly, it will link us to world prices for the first time in this country's history. So whatever world prices are, we're going to get. They might be terrible, but they might also be great. But on balance, that differential, I think, that we have suffered across all commodities is about to change. Mm-hmm. At least for a few years. I mean, I don't think we're going to over-drill these basins again like we have in the past to horrific levels. But on balance, if you look at average basis differentials across, periods of time, Canada is about to be in a much better place than it has been historically.
The thesis was that it was a supply shortage. Are we still kind of in that crunch, or are things leveled off?
Well, it all gets back to capital discipline. I think if you look at natural gas production at 103 BCF a day, it hasn't, it's kind of been plateaued there for a while around 100 BCF a day. I mean, there are some basin differential issues that are vexing North American production, both in Canada and the United States. Europe has done an incredible job destroying their demand through industrial destruction, which is not a good thing, but also aggregating supply from various parts of the world, which unfortunately none of which are Canada because of our industrial policy. But nevertheless, prices there are probably going to be lower than I thought they would have been a year ago. A year ago, I would have been very, very bullish on their prices, kind of bearish on their situation there because, but there'll continue to be a differential. So all in all, the biggest thing that I see, again, I can't predict price. I'm terrible at it. So I really don't care. I just want to identify companies that are solid investors in the sector and can maintain low costs and high returns on capital, and try to manage my exposures based on what I think the fundamentals are for the sector. And right now, I think they'll be choppy, just choppy. It's going to chop like oil will chop between $60 and $110 a barrel. And, until I see otherwise, I'm just going to plan accordingly.
Are they still undervalued in Canada?
Well, no, I don't think they are. At the end of the day, we in this country, unfortunately, we don't know. We have some external risks, and that is our industrial policy as it pertains to the energy sector. It's a disaster. Like it's a disaster. It's a divisive disaster that separates province from province, and it's terrible. Like it's really, really terrible. It's a bad news thing, Trevor. And as a result, this industrial policy is really. It's just so much easier to buy Exxon. Why wouldn't I buy Exxon? Look how much it has the same volatility or better. Its market impact is as good or better. Mm-hmm. What are you going to buy? Suncor? It hasn't done much in 5 years. And then you never know what the next press release is going to be from Stephen Guilbeault or Justin Trudeau. Mm-hmm. So Canada's got some healing to do over a result of some of these non-industry controllable factors. And it'll happen. It'll happen. I don't know on what time frame, but it'll happen. But there is definitely a discount. It's so much easier. And the same goes for, it doesn't matter if it's Canada, it could be Europe, could be a bunch of other different jurisdictions. If you're a global investor, you're probably willing to pay a higher valuation for a U.S. oil and gas company just because you're not likely to face a non-controllable event. This is the key. These companies continue to delever. In fact, there's one of the greatest oil and gas investors of my generation was a guy named Mark Bridges who worked for Connor Clark, and he was one of the first people that I ever met who applied this deleveraging type of perspective to oil and gas companies. And at the time, it was totally iconoclastic. These were back in the olden days when we were doing 5 deals a day for junior oil and gas companies, and it was run and gun. And he sat back. Remember, he went on vacation one day. He came back and he said, "Trent, sell everything." And and I said, Mark, what's going on? I said, these companies, they're just crazy. I'm changing things up. And this would have been 2005 or 7 or something like that. He consistently had some of the best risk-adjusted performance in the sector for years. And it's a result, I'm convinced, of his early adoption of this idea that I want to buy companies that are deleveraging because of their high profitability and pair them against companies that are just utilizing whatever tool, financial or physical, that they can to grow for the sake of growth. And that turned out to be, on a risk-adjusted basis, a pretty good strategy for him over the years.
Do you miss the 5 deals a week days?
Well, when I was an investment banker, it was pretty good. But again, the businesses are better. The 5 deal, it's a good question. And I appreciate it because I look across at the renewable energy sector, and I don't know if you're familiar with what the dynamics of that sector right now, but it's a disaster. It's been a disaster for about a year. And I looked at those charts, and many of them are down. There was a stock called Solar Edge. Late last week, it was down 35% one day. And I looked at them, I said, you know what? God, this certainly reminds me of the oil and gas sector back in the early 2000s. They had free access to money, no controls over their spending. An incredible mania, back in those days, the narrative was commodity super cycle. I'm using air quotes, commodity super cycle. all commodities must go up forever because we're massive growth in economies worldwide, shortages, no investment, blah, blah, blah. Well, sure. Multiples expanded rapidly and people started, raising money and drilling wells for oil and gas, drilling, exploratory wells for copper mines and da-da-da-da-da. So, but now you've got the literal opposite. And you don't have that in the energy sector, but you certainly have it in the renewable sector. Now that they can't get projects across the line or the projects aren't working, the earnings isn't there, the market's holding them to task, and these business plans are completely falling apart and going to zero. Right. So so the answer to this. As an investor, God forbid they ever come back. It's much better this way. These are great businesses. It's better for the investor. It's better for the employees. It's better for the country. It's better for the tax base. I mean, it's just better. I mean, these are very solid, stable companies now, and they're great.
Do you ever think about starting an investment bank again?
Yeah. I mean, look, some of my best friends work at investment banks, and our partners in investment banks have a tremendous amount of their capital tied up. That industry's undergone a tremendous amount of change. Would you start up in an investment bank that advise issuers on what they should do with markets? Sure. Is it going to look like FirstEnergy did in 1997? No. The skill sets of the investment bank have changed, and companies that don't change in that industry will follow the wayside, and companies, that have changed will. I foresee that the companies that have in the energy sector that have done well have amped up their ability or increased their ability to provide really specialist value-added advisory. And they've de-emphasized their agency trading, and they've de-emphasized, well, let's say they haven't de-emphasized their research. They probably invigorated their research by making it more worldly and macro-oriented. And they've also been aggressive when new plays are identified by really capturing and corralling the issuers that are involved in those new plays and dominating and being real sharp elbows. Mm-hmm. And so what that's done is allowed those investment banks to prosper, where other companies that don't have either the ability or they just weren't successful at changing to that model, they haven't been as successful.
It just seems like there's, I guess, a void almost in that space with the investment banks because there's no new startups. But on the other hand, there just hasn't been the business either. So that's why.
Well, it's funny you say that because if you talk to a buy sider, they would say, you know what, this sector is still way overbanked.
Yeah. Right.
So it's a different perspective, right?
Right. Ian Bruce.
Yep.
I thought we could do a quick shout out to him.
Yeah, let's do that. Yeah. Ian was he was my boss, when I worked at Peters & Co. Okay. And, he was just an absolutely terrific, humble, smart, investment banker. He would treat the Prime Minister of Canada and the lowliest guy on the street just the same. And he's great with his hands. He was down to earth guy. He loved to work with his hands. And he was a great leader at Peters & Co. And we're all going to miss him for sure.
Maybe who was Ian Bruce?
He was an investment banker at Peters & Co., one of the senior partners. And when he arrived at Peters & Co., we were a shop that pursued junior oil and gas deals. That's what we did. It was before the days of the internet, really. And I'm telling you, like it was really the olden days. And we did junior oil and gas deals. That's what we did. Right. And Ian came over from one of the large banks. I think it was Scotia at the time. And it was really interesting because he brought a more senior company perspective to the bank. And he was just a calming influence in that regard. So, he had lots of relationships at high levels throughout the sector. But most of all, he was just an honest guy that people trusted. And so, yeah, he's gone too soon.
When I was preparing for this conversation, I read your tweet on Ian. And, one of the things he told you is that to say hello to the bull for me. Who is the bull, if that's a public thing that you can reveal?
Yeah. So one of my former business partners and a mentor and someone I respect and care for very deeply, Jim Davidson, and we called him Jimmy the Bull because it didn't matter. It didn't matter the day. Jimmy was bullish. If you came in, if you talked to Jimmy, he was bullish. And that was always a treasure, particularly in the dark days when there were like really dark days, like, for instance, the Halloween surprise when they changed the trust regulations and things like that. You know, Jimmy was always he's a terrific leader and still is and would rally the troops. And so he had a nickname. We call him Jimmy the Bull.
That's great. Well, we've kind of covered M&A, pricing, volatility. What do you think M&A is starting to bubble up now? Where do you think it's headed as we head into 2024? Do you think there'll be more M&A or is
I do. I think what you'll like, as I mentioned before, the companies that have had the biggest growth and market impact are the smaller entities. When I say smaller, I don't mean tiny. I mean the intermediate to mid-cap companies that have aggregated plays over the course of the last 5 years and maintained productive employment rosters and are generating good, strong returns. So their market impact has increased dramatically. And in Canada in particular, we have one of the best natural gas plays on earth left that's largely untapped, and that's the Montney. You know, it's really they've just scratched the surface on that thing. And as a result, companies that have significant ownership in that play, I think, will continue to be consolidated. And there have been a couple of new oil plays. The Clearwater play is just getting bigger and better every quarter. The profitability is extraordinary. I heard there was some talk of there being developed at actual crude oil grade, Clearwater grade oil that could be offered sometime in the next year. That's how big a deal it is. So those types of plays come and go. So that's a real exciting one. That'll be consolidated at some point. The Charlie Lake has gotten better than it was, say, 10 years ago. That'll continue to be consolidated. So, you know, I really think that, this M&A trend will continue for some time, particularly when you look at the top five in the market impact sweepstakes here. I mean, Suncor, Cenovus, Imperial Oil, Ovintiv, you know, these companies are going to want to increase their market impact or else they're going to fall to the wayside. And you'll see some big deals too, like between companies like that.
Do you worry that the deals are done right? Maybe influences on the banking side kind of dilutes the quality of the deal, or if you could pay cash, that would be ideal. But do you worry that sometimes there's too much equity issued, or are you confident?
Well, it really depends on the issuer. On balance, the market investors are doing a good job causing oil and gas companies to be disciplined.
Yeah.
And that's why I think a lot of the deals that we've seen have been successful. Like they've been actually quite successful.
Right.
I tend to think that we're going to see more of the same. I think that, you know, as I said at the top, I think that buyers will be rewarded. Not on deal day. They're never rewarded on deal day, but they will be rewarded by identifying targets and acquiring them to improve their market impact. And from the perspective of the acquired, they should want to do that deal because it will improve the value of their assets. Mm-hmm. So if they're taking back paper, they're going to be happy to do that.
The worry is that you just issued all these shares and that you just bought something that may be great. You have all this inventory, but now you doubled the share count. And now I'm left with this maybe a good asset, but you've totally blown up my share count.
Well, let's take a look at Hess and Chevron. Okay. So before Chevron did the Hess deal yesterday, it had $41 billion of EBITDA for 2024. Okay. And Hess was supposed to have 7, right? Well, today they've done the deal. So let's call that, I don't know, it's $54 billion of EBITDA for Chevron. Fast forward today, you've got now the combined entity. It'll have something like $63 billion of EBITDA. Mm-hmm. And $40 billion of CapEx and share buybacks. It's going to have $20 $4 billion to pay interest, account for depletion, and pay dividends. It's astounding. And what's interesting to me is that Chevron before this deal had capex of like $15 billion, and they were repurchasing $17 or $18 billion worth of stock. So what's really happened here, what I think is kind of interesting about this deal from the purchaser's perspective, is that they'll have acquired Hess, and their combined capex and share buybacks can be completely funded by old Chevron. So the incremental $7 billion is just a freebie. So, I think they'll be rewarded for it. They should be rewarded for it because they have increased the pace at which they can delever, which is evidenced by their commitment to increase the dividend and increase the share buyback as a result of this transaction.
Well, where are we at for time? That's almost an hour. As we head into winter, you're expecting more M&A? Prices are volatile. I'm not sure, but you're a little more optimistic, obviously, than you were at maybe a couple of years ago. Things are looking up for the sector in general.
The sector's great. I absolutely love it. I think the future for the sector is probably never been better in my life. And I lived through some pretty good times. But it's just the businesses are just so much better. These are cycles of change, but the cycle appears to be extended now. I mean, at the end of the day, these companies are very profitable. Yeah. Something might happen, Trevor, where people realize, gee whiz, we're not going to be on the downslope of oil demand in 2030. We've got a bit of a problem here. We might still be growing. I don't know when that day is going to happen, but it might be 5 years from now, but at some point people might say, holy crap, we are short of this stuff. We need more. And then multiples will expand. But there's a lot of great return in the meantime. And I think that decades of growth in this industry. And even if the growth is more moderated, we're not going to go from 100 to 200 million barrels like we went from 50 million barrels to 100 when I started to now. Some of the best years from perspective of profitability of this sector are in front of it.
One thing I have to tell myself is I'm totally biased. I own a lot of energy shares, and that really clouds my judgment. Do you ever think about that? How do you remain unbiased?
I'm not unbiased. I'm very biased. I'm very pro energy wealth. There's no country in the world that suffers from energy deficiencies that is wealthy. And I am very biased toward the affordable access of energy. And as a result, I'm biased to support this industry. So I'm the wrong guy to ask.
Yeah. With my portfolio, and I try to keep an objective perspective.
Yeah.
But it seems like from that angle that things are pretty good. Right now.
Well, back in my old chair, Trevor, if you were a money manager and we were having beers at Benjamin Hotel Bar in New York, and he asked me the same question, I'd probably say something like, you have to judge each of these investments on its merits.
Right.
And so the merits of this investment, in the energy sector can be benchmarked against the entire universe of opportunities. And right now the valuations look pretty good. Mm-hmm. And the outlook looks pretty good. So you might as well concentrate some effort on this sector. On balance, you're falling out of a basement window. You're not likely to get hurt. The free cash yields across the sector are very impressive. It's good. I'm really looking forward to this Q4 reporting period because it's been a pretty good year for the sector.
Yeah.
So I think we should have seen some significant deleveraging across the spectrum of companies.
Tourmaline is cash positive.
Correct.
That's incredible.
Correct. Like the rate of change I think 2024 will be an interesting rate of change trade. If you're a trader, there'll be an interesting rate of change because there will be enhanced deleveraging across the sector. I think it'll be more of a rising tide. for the equities because of the deleveraging attribute in the income statements right now.
Well, that's a pretty good summary. If you were to leave maybe anyone listening to this episode with a message for investors, this isn't financial advice, but what might you tell them as we head into 2024? Stick with quality. Maybe there's some undervalued ones out there, energy stocks. What would you tell them? I'd
tell them this. The Rose Bros podcast is the best value in markets right now.
We'll leave it there with the plug for Rose Bros, the Rose Bros podcast, which is growing. So,
okay. Thanks a lot.
Thank you very much.
Talk soon.
Thanks for listening, everyone. Hopefully you enjoyed the episode. If you liked what you heard, check out rosebros.ca, where we will have upcoming shows. Until next time, happy coffee drinking.